Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the corporate jungle. Sometimes it feels like they're re-offering you their entire kingdom on a silver platter, and other times, well, you'll see. Today we're re-diving into a filing from ScanTech AI Systems Incorporated. This report dropped on the 10th of October 2025, and it has got some pretty interesting moves happening with their financing. If you appreciate getting straight insights from corporate documents, make sure you are subscribed. We also have a Discord community linked in the description below, so consider joining us there too. So, what exactly is this filing? It is a Form 8K, which is basically a company telling the Securities and Exchange Commission, or the SEC, about big events that could affect their business. Think of it as a really important announcement that shareholders and investors need to know about, and fast. The company behind this report is ScanTech AI Systems Incorporated. They re-involved in AI-driven security technologies. Now, usually when we look at these 8K forms, we re-often hunting for those juicy financial tables. But this one is a bit different. It is more about a strategic agreement that could significantly change how they fund their operations and growth. The core of this filing is about ScanTech entering into a new agreement, specifically an equity line of credit or ELOC purchase agreement, signed on the 8th of October 2025. This is a pretty big deal for a company like ScanTech. This agreement is with ARC Group International Limited, who will be acting as the investor. Now, what this ELOC essentially means is that ScanTech has the option, but not the obligation, to have ARC Group buy up to $50 million worth of ScanTech as common stock. Think of it like a flexible funding source they can tap into as needed. On top of that immediate funding potential, the agreement also states that ARC Group will buy a specific amount of ScanTech S stock right away. They're repurchasing about 1.4 million shares for a total of $500,000. That works out to about $0.356 per S hair. This initial investment gives ScanTech some immediate cash to work with. Now, let's talk about that $50 million equity line. This is tea-free money. ScanTech can decide when and how much they want to draw from this line. But it comes with conditions. They need to file what is called a registration statement with the SEC to allow for the resale of these shares. This is crucial because it makes the shares legally sellable on the public market. They have to get this registered, meaning the SEC approves it for resale within 90 days of filing. Until that happens, they can even start drawing on that equity line. When ScanTech does decide to draw funds, they send what is called an advance notice to the investor. They get to choose the amount, but there are limits. Each draw can be more than 75% of the average daily trading value over the last 10 days, or $5 million, whichever is less, unless both parties agree to change that. The price they get for these shares is also dynamic. If ScanTech is making a new draw and there isn't an existing one ongoing, the investor will pay 96% of the average trading price over the 3 days. Following the purchase, if they reinitiating a new draw, while another is still in progress, they might get 100% of the trading price on that same day. This pricing mechanism is designed to incentivize the investor while giving ScanTech a chance to raise funds at potentially better prices if the market is moving favorably. There are also ownership caps in place. The investor can end up owning more than 4.99% of ScanTech as outstanding stock as a result of these purchases. This is a common feature to prevent any single investor from gaining too much control too quickly and potentially triggering issues with public trading. Beyond that 4.99% limit, there is also what is called an exchange cap. This limits the total amount of stock that can be issued under the ELOC to 19.99% of the company. As outstanding shares, if they need to issue more than that, they need to get approval from their shareholders. This is important for existing shareholders because it prevents excessive dilution of their ownership stake without their say. So, as a sort of upfront fee for agreeing to this ELOC arrangement, ScanTech is issuing about 3.87 million shares of its common stock to ARC Group. These are called commitment fee shares and are valued at $1.75 million. This is essentially the cost of having that $50 million funding option available. Interestingly, alongside the commitment fee shares and initial subscription shares, ScanTech is also issuing what are called pre-funded warrants. These are essentially warrants that are already exercised at issuance, meaning they give the investor immediate ownership rights similar to stock, but with a nominal exercise price. These are coupled with the commitment and subscription shares, totaling a significant number of shares and warrants being issued. The investor can adjust their ownership percentage limits on these warrants, but generally they are capped at 9.99%. ScanTech has also agreed to cover the investor S legal fees related to this deal, up to $30,000. This ALOC purchase agreement has a term meaning it doesn't last forever. It will automatically end on the 3-year anniversary of the agreement, or sooner if the investor has funded the full $50 million commitment. ScanTech can also terminate it with notice, provided certain conditions are met, like no pending draws and all payments made. So, what will ScanTech use this funding for? The filing states they plan to use the initial proceeds from the subscription shares and any future sales under the ELOC for working capital, advancing their AI-driven security technologies, and general corporate purposes. This suggests they're looking to accelerate their product development and expand their operations. Now, let S touch on how these securities are being offered. The filing clarifies that the shares being issued under this ALOC are being sold in a transaction that is exempt from the standard registration requirements of the Securities Act of 1933. This is typically done under Section 4A2 of the Act, which allows for private placements to sophisticated investors. Arc Group International Limited has represented that it is an accredited investor, meaning it meets certain income or net worth criteria, which allows for this exemption. This means the shares are not publicly registered and may have restrictions on how they can be resolved. Finally, there is a disclosure about a press release being issued on the 9th of October 2025, announcing this agreement. This is part of Regulation FD, which ensures that all investors receive important information at the same time. The filing also lists several exhibits, including the form of pre-funded warrant and the actual purchase agreement. These are the detailed legal documents that back up everything discussed here. Now, looking at this filing, ScanTech AI Systems Inc. is clearly prioritizing securing significant funding to fuel its growth. The equity line of credit offers flexibility, allowing them to raise capital as needed without being locked into a single large offering. The initial $500,000 investment from Arc Group provides immediate liquidity, and the $50 million potential provides a substantial runway for future development and operations. However, there are always risks. The reliance on an equity line means that the value of their stock price directly impacts how much capital they can raise. If their stock price falls, they issue more shares to get the same amount of cash, which can dilute existing shareholders. The ownership limitation of 4.99% for the investor is designed to mitigate immediate control concerns, but the overall 19.99% cap highlights the potential for significant dilution if ScanTech fully utilizes the ALOC without shareholder approval. The company's strategy right now seems focused on investing in its AI technologies and general corporate needs, which is typical for a growth-oriented tech company. The success of this strategy will depend on their ability to innovate, bring their security technologies to market effectively, and manage their cash burn efficiently. The agreement's termination in 3 years also means they need to demonstrate sustainable growth and profitability by then, or secure new funding sources. In conclusion, this ALOC agreement is a strategic move by ScanTech AI Systems Incorporated to ensure it has the financial resources to execute its growth plan. It is a double-edged sword though, offering significant opportunity alongside the inherent risks of equity financing and potential dilution. Investors will be watching closely to see how effectively they deploy this capital and manage shareholder value. Alright, that is our breakdown of ScanTech AI Systems Incorporated's latest filing. What is your take on this funding strategy and what it signals for the company's future? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more deep dives into corporate finance. Don't forget to check out our Discord community in the description for more discussions. Thanks for watching, and we'll see you next time.